In the world of Forex, trading revolves around currency pairs, and one of the most critical decisions a trader makes is whether to go short or long. These strategies, known as short trading and long trading, are foundational concepts that reflect a trader's expectations regarding price movements. Let's begin with short trading, commonly referred to as going short. This approach involves selling a currency pair with the expectation that its price will decrease in the future. Essentially, the trader bets that the value of the first currency in the pair will decline relative to the second. For instance, if you're trading the EUR-USD pair and take a short position, you're selling euros while buying US dollars. Your goal is to repurchase those euros later at a lower price, profiting from the difference. Short trading is particularly effective in bearish markets or when a trader identifies signals that a currency's price is about to drop. Technical analysis tools, such as chart patterns, momentum indicators, or support and resistance levels, are crucial for pinpointing entry and exit points in these trades. However, this strategy comes with significant risk since markets can move against expectations, leading to losses if the currency's price rises instead of falling. On the other hand, there's long trading, also known as going long. Here, the objective is entirely opposite, buying a currency pair with the expectation that its price will increase. In this case, the trader believes that the first currency in the pair will gain value relative to the second. For example, if you decide to take a long position in the GBP-JPY pair, you're buying British pounds while selling Japanese yen. If the pound's price rises against the yen, you can sell later at a higher price, securing a profit. Long trading is often employed in bullish markets or when a trader has confidence in the strengthening of a particular currency. This strategy may rely on technical analysis but is often influenced by fundamental factors such as economic news, monetary policies, or macroeconomic reports. Patience is key in long trading, as it may take time for the market to move in your favor. Both strategies, short and long trading, are vital to understanding Forex market behavior and form part of every trader's toolkit. What truly matters is understanding the context in which they apply. For instance, a short position might be suitable during an economic crisis that weakens a specific currency, whereas a long position might be the right choice in a stable economic environment that supports a currency's growth. Regardless of whether you choose to trade short or long, risk management is essential. Utilizing tools like stop-loss and take-profit orders helps limit losses and lock in profits, even if the market moves unpredictably. Ultimately, the key is to have a clear plan and base your decisions on careful market analysis. In summary, short trading involves selling a currency pair in anticipation of its price falling, while long trading involves buying a pair in the hope that its price will rise. Both approaches have their place in Forex and can be adapted depending on market conditions and trader preferences. Understanding these strategies will enable you to make informed decisions and seize the opportunities this dynamic market offers.